All right. Hello, lovely people, and welcome. Thank you so much for joining us today. My name is Charlie Rose, and I'll be your host for this session. Our speaker for this lecture is Jonathan Hoenig, a regular Fox News contributor and the portfolio manager at Capitalist Pig Hedge Fund. He's also just written a new book, which is called Price is Primary. Wonderful addition and perfectly matches our topic for today. To our wonderful attendees, please type any questions that you may have into the live chat box. Time permitting, I will announce your questions at the end of Jonathan's presentation so that he may answer them. All right, Jonathan, if you need anything, I'll be right here. The floor is all yours.
Thank you so much, Charlie, and thank you to the Money Show for having me once again. And thank you most of all to all of you for joining me today with a great, as they say, jam-packed presentation. It does cover a lot of topics ripped from today's headlines, but also a lot that's in the new book, my new book called Price is Primary. So I have a lot on that as well. So obviously it's in the headline, it's in the title of the topic. So let's, as they say, get right to it. Why is price primary? And why do fools follow fundamentals? Well, I have one word for you. I don't know if anyone can guess it. One word that explains it. Why? Bitcoin. Okay, Bitcoin. Bitcoin just basically sums it up, certainly over the last couple of years. I mean, Bitcoin has risen, I think dramatically is basically an understatement. Without any really public use, it hasn't had any major adoption yet, at least. It has certainly no intrinsic value, but it has moved dramatically. Price is what's mattered. Now, why should you even listen to me? Well, I have a little bit of experience in this. I started actually trading soybeans without knowing much about soybeans at all. Certainly the best traders I knew on the floor of the Chicago Board of Trade, they weren't the best farmers. They didn't even have the best agricultural backgrounds. They just were following price. That's where I got my start at the Board of Trade. I started my own investment firm in August of 2000. You know that photo is from that era because if you look, you can actually see a telephone on the desk. You younger viewers, younger people might not even remember what that was. We actually used to have a telephone on the desk. And over a 20-year period, I actually beat the S&P 500, which is something that less than 15% of active managers can do, including my fees. So I'm quite proud of that and quite proud of the work I've done in the investment field. But it's taken some time. And there you see me looking quite confused on the floor of the Board of Trade, wondering what was going on in this complete kind of tumult of prices and news reports and action. And, you know, for me, it was a lesson, but it was an expensive lesson. You know, there's a wonderful line from Reminiscences of a Stock Operator from Jesse Livermore that the game taught me the game and it didn't spare the rod while teaching. And we're all students of the game. I think we continue to be students of the game. I have an old saying, I say, I don't get better, I just get more numb. And the market never spares the rod and it's always teaching. So it taught me to focus on what matters. Anyone want to take a guess what that is? You're right, price. Price is what matters. In fact, price is all that matters. So let's start briefly at the beginning. We're here, we're investing in the market. What is the market? You're all probably thinking, well, you know, it's companies and it's the products and CEOs and I don't know, the inflation rate and the new Fed chairman and all this, excuse my French, but cockamamie garbage. I'll say it. Yes, I'll say it. They might have to bleep it out, but I'll say it. Cockamamie garbage. The market is price. I mean, if we're talking about, you know, the investment markets here, you know, the bazaar out on your street, if you're in the Middle East, eBay, these are different markets. I'm talking about the investment market. These are markets of price. The market consists of prices. That's what it is. And for us, qua investors, they are the tangible existent. They are what we actually trade. They're what we interact with. They're what the market is literally made of. The market is a market of price. So we don't trade a stock's earnings. We don't trade anything about it. We don't, you know, there's people and I respect them. Well, let's just say what we trade is the price. At the end of the day, talk. You know, we used to say on the Board of Trade that fundamentals are something you read while you're on the can. Now that's pretty off color. I wouldn't necessarily put that in print, but we trade price. That's what we trade. And, think of it this way, a little less colorful, if you will, like the old detective. You want to be a detective, a market detective, and you're saying just the facts, man. So what are the facts? Earnings reports, CEO, inflation rates, fundamentals? No, the facts are the price. If you're interested in making money, the facts are the price. And it starts with accepting that price is what it is. In the book, I talk about this as metaphysical reality. What it is, what it is, regardless of what we think about it, regardless of what we feel about it. If we think of it's too high, too low, undervalued, overvalued, and it can't be ignored. You can't say, oh, I know a stock is down, but you have to just accept it for what it is. It's automatically perceived. Now, price is not valuation. So a lot of times people think, well, it's high, overvalued, low, undervalued. So you have to kind of get yourself, when you start focusing on price, price is primary, obviously. When you start focusing on price, you need to kind of brainwash yourself out of thinking as an asset as, for example, overvalued or undervalued. And this is almost almost inbred that we are focused on looking for things that are undervalued, and we want to be we want to find something that's undervalued and wait till it gets what we think of as being normally valued, I suppose, or find things that are overvalued and wait till they get undervalued. It's a strange way to look at markets, and certainly I think a very difficult way to invest. The only equivalent I could say would be like going out in the middle of winter with a Speedo and saying, I'm going to wait until it's summer. It's you're ignoring reality. So an asset is not overvalued or undervalued. If you're interested in price, you just say it is. It is what it is. Like a tornado or like a sunrise. You would never say, well, that tornado is just too strong, or that sunrise is just too orange. It's the sunrise. It is what it is. It's the same type of indifferent deference you have to give to price. So here's a great example. Now, I would never call someone a fool, but I'm often that fool. We're all fools when we follow fundamentals. And this is a great example. Want to know an overvalued stock? Amazon. Lo and behold, and Amazon has been overvalued ever since, I don't know, basically since it's been a public company. Look how it's performed over that period of time. Now, this is not a buy recommendation for Amazon, and I've never owned Amazon. So this is not a coulda, shoulda, woulda. This is to illustrate the point that, to put it in adjusted Livermore's terms, a stock is never too high to buy or low to sell. Amazon has always been overvalued. I mean, back in 2016, its PE ratio, if you actually subscribe to that, was, 400, and what they used to say is non-meaningful, and it's still 70 plus. So it's, it's cheap, on no normal scale. So it's still overvalued. It's always been overvalued. And you know what? Yes, it earns a profit now, but it's never really made any. Revenues have been tremendous, but it's never really made any huge income as a company. Certainly nothing relative to its revenues ever. Its profits are still minus or minuscule. But don't think of it as overvalued. You want to think of stocks like Amazon, stocks, for example, hitting new all-time highs, 52-week highs, 6-month highs. Stocks doing well, you think of them not as overvalued, think of them as strong. So think of a stock as strong. And if you're at Belmont, I don't know, if you're at wherever they run horses now, they've closed my local track. So Arlington is no more. But if you want to go to the racetrack, you want to bet on a strong horse. You don't want to bet on a weak horse, hoping that it turns around and, but that's the kind of stocks people like to buy. They want to bet on a weak horse. And so you want to bet on the strong horse. So focus on that. And how do you know it's strong? You see it in the price. Let's look at the other example now, undervalued, because that's even more, something we kind of seem to gravitate towards. When you think of, what is the kind of classic name that has been undervalued for so long and people, excuse my French, have gotten their keister, yes, I'll say a keister, handed them to them? Well, I'll get to that, but the point is that you don't want an undervalued stock. This is my own, and I'll take credit for it. Stocks are like sushi. You don't want a bargain? If I offered you that piece of sushi and said half price, you'd say, oh God, I don't want that. So you don't want a terrible stock at any price. You don't want a weakness at any price, even if it is a quote bargain. And GE is the quintessential example of that, certainly kind of in recent memory and recent history. I mean, GE, you have to kind of understand, maybe for younger people, GE is, I don't know, it is the kind of, well, I mean, everyone seems to know how important GE has not only been kind of the history of the markets, but up until recent years, the market itself. But look at just even the last 20. And I came up, in the 90s, in effect, when GE was, I guess it was kind of like the apple of its day, if you will. It was the #1 market cap stock and just moved the markets. And basically, this has been the last at least 17 years for GE. It's been undervalued for a long time. In fact, that's what the analysts have been saying. GE's return from 2004 to 2017 was -5%. And it wasn't like there was a bear market during that time. And the S&P was up 200% over that time. But during that time, analysts were positive. They were bullish on GE almost 100%, 98% of the time. And time after time, their argument was, wait for it, it's undervalued. It's undervalued. It's cheap relative to where it should be, cheap relative to the market, cheap relative to book. And, this was a common thing this wasn't off the mark. I mean, people considered GE over and over again the buying opportunity. Big name investors took positions in GE. They thought it was cheap. General Electric is all right. It was seen as the gold standard. But, of course, it was weak. And what's the worst thing you could do would be, well, the worst thing you could do at a horse race would be to bet on the weakest horse, right? The horse that is hobbling in, you would never bet on them. But if you bet on them once, would you ever bet on them again? Well, that's what you're doing. And, in the book, I talk a lot about the difference between epistemology, which is understanding what's happening in the market. And I understand that as trend, and ethics, which is how you act. Ethics is the field of, we can't control the market. That's like the hurricane. It's like the sunrise. It's out of our control. What we control is how we can act. That is the field of ethics. And that's where most people, if you will, hang themselves. How they act. It's not even what their stock picks are. And the worst thing that the worst way to act that fits into this whole idea of value is, of course, buy low, sell high. Whoever came up with that they've done us all a huge disservice, because what is low? I mean, think of all the money that was lost, buy low, sell high in GE, thinking that for some reason that weak racehorse is going to turn around. Buy low, sell high. I mean, you're buying a stock that is continually hitting new lows. Whatever your context is, 1 month low, 6 month low, 8 month low, all-time low. Again, you're like going out in the winter and saying, I'm wearing this Speedo today. And even if you've got a great body, and my sense is you probably do, you do not want to be outside in the winter wearing a Speedo. But that's what you're doing when you're going out day after day after day when a stock continues to go down. And of course, GE is a great example. I mean, you could have, destroyed a portfolio very quickly with that doubling down, the old martingale strategy. Didn't work for LTCM. It's not going to work for you, and it certainly doesn't. It's never worked for me. So buy low, sell high is and doubling down like this is, as they say, every big loss started with a small loss and an investor who had to be right. This is how it happens. So don't bet on undervalued. Don't focus on weak horses. Don't bet what they're nice to pet, but you don't want to put your money on that. Now, so talk about fundamentals, because people always say, "Oh, well, you're a technician. You're just this unthinking robot. That you would just buy anything. You would just, So I'm very safe. I stick to the fundamentals. Fundamentals are always brought up as being kind of a safe way to invest. They're really anything but. They're anything but. Now, I have to say, in full disclosure, just because something rhymes does not mean it's accurate. And in the investment markets, and I think in life writ large, we often think that just because something rhymes, it's not true. For example, sell in May and go away. You've heard this one. It's not always true. I mean, just because May was weak in 1983, it's nothing to do with May this year. They're unrelated. They're in different worlds in effect. So don't fight the Fed. Don't fight the Fed. It's almost like, if I think it was NWA did Fight the Power. If they wanted to come back and kind of do it for don't fight. Sounds cool, but oftentimes fighting the Fed makes money. So don't, that has nothing to do with trend. It has nothing to do with the market. That's why you throw that out. When in doubt, get out. I talk about this a little bit in the book. I mean, we reference JP Morgan's idea that you want to sell down to the sleeping point, but doubt is an inherent part of a bull market. I mean, as the old saying goes, and this is the saying you should know, it's bull markets are built on doubt. Bear markets are built on hope. So this is not actually right. When in doubt, get out. So it rhymes, it sounds snappy, but it's not true. However, fools follow fundamentals. I should put a little TM up there. I won't. I'll give that to y'all for free. That's true. It rhymes and it's true. Because fundamentals, as we know, especially now, I mean, it was true even in the 80s and 90s, but especially now when we've got a supercomputer on our hip and in our hand, the fundamentals are already incorporated into the price, well incorporated into the price. And that's why what we do, and there's a reason they call what we do speculation, because if being successful was just like opening up the journal, I guess they don't even print the journal anymore, but clicking on the journal and seeing like, what are the cheapest stocks and buying the cheapest stocks. If it was that easy, if it was kind of printed in a book, we'll just do, then everyone would be rich. If there was just and that's all due respect. There's, I think, a lot of people who believe in that. They believe in what I would consider to be an intrinsicist approach to markets. For example, always got to be in gold, always got to be in real estate, always got to be doing covered calls. So they believe in one strategy, no matter what's happening. So my belief is that you want to be objective. What does that mean? You start with the market itself, and then you, in effect, decide what that relationship is going to be with you as the investor. And then a lot depends on that. You, the investor, the condition of the market, other things in your portfolio. So there's a lot going into that. Is it you as an individual with that market? But there's a reason they call it speculation, because we don't have all the information. So we act in absence of complete information. That's in effect. I mean, the efficient market people would say that's how we get paid, right? We get paid to take that risk. And the whole thing with ethics, as I talk about in the book, is that you can take a risk. You can buy the riskiest stock in the world. You can buy Bitcoin. You can buy shitcoin or whatever those dog coin, whatever you can. But as long as you put, for example, a 5% position size and a 55% stop loss order, you're going to live to tell. You're not going to kind of take yourself down with the ship. So you could have bought the worst possible things at the all-time high. Pets.com, I don't know, people don't even remember that one anymore. Some of those things that imploded in 2008. I mean, it's like the names, but you can buy the worst stocks in the world. And as long as you have some type of risk control measure, and with all due respect to Peter Schiff, who I really enjoy as a person and as a friend, I was shocked when he said to me that he doesn't use stop loss orders, because I feel like, well, a lot of, they can only go to zero, and oftentimes they do. Here's why fundamentals are dangerous, because think back, if you can, do Greece. Never been there, but I can't say it's high on my list, given a lot of these images. This is going back to what they called the Greek austerity movement in 2013 and 2014. You might remember this. I don't know, to me, that looks like, it's like Predator. I don't know if anyone remembers Predator, but that looks pretty serious. And as an investor, you would never look at that and say, get me in. The fundamentals were terrible. I mean, you had huge interest rates, you had riots in the street, you had, shutdowns every day. But look at what was happening with Greek stocks during that exact period. They were not just outperforming. Markets in general were strong, but look at Greek stocks in particular. GREK is the ETF that tracks Greek stocks. And in that period, it was just completely trouncing the S&P 500. And that's the ETF. So, even if you were kind of delving down, and I talk about it in the book, the idea of like, don't just buy the ETF. If you can, if it's appropriate to your, your investment size, your risk, everything, your own context, drill down into an ETF, because oftentimes an ETF is just the biggest stock, the most liquid stock, because these are ETF providers. They just want to get something that's kind of family friendly, if you will. But as individual investors, we can go find like the obscure OTC bulletin board, that is linked to the Greek bank that only trades 500 shares a day. One of those can be ours, in effect. So, I talk about that in the book. You want to find the less liquid names and something like this that's performing well. So, following the fundamentals, this is a great example. Oftentimes, I don't like the saying, buy when there's blood in the streets, but the idea is that look at that when a stock is breaking out and it's bad news, that's the follow the price. Price is primary. Who follows the fundamentals. Here's another example. Cisco. Cisco really was like the Apple, I guess, of its day, really, because it was the technology story. This is Andy Sewer, who I now believe is the head of Yahoo Finance. He wrote in Fortune that a bet on Cisco is a bet on the pure, unadulterated growth of the internet. No matter how you cut it, you have got to own Cisco. And I remember May of 2000, let me see, I'm 29 now, so I was a little younger back then. It's 20 years ago now, but I remember that. And the internet, if you think about it, was just starting up. And the internet did take off. I mean, in 2000, it was basically 50% penetration rate of the internet in America, if you can believe that. Only half of America was, so internet penetrations of 100% since 2000. Pretty amazing. Cisco has taken off. Its sales are up 230%. Its net income is up threefold. Its revenue is, trebled since 2000. But here we are in 2001 or 2021, and Cisco is still at 30% of its 2000 price. So if you were waiting because the fundamentals have been improving, the fundamentals have gotten a hell of a lot better, and the internet did take off. That's the point. The internet did take off. But Cisco, its price had anticipated the move, and it's taken now 20 plus years to even begin to start to shake it off. So let me go back to Bitcoin. I want to leave some time for questions. I have to mention, I did see some news for Bitcoin today. I'm going to make a fearless prediction because I know everyone's very into crypto this year. I have a little section in the book about basically the idea is find out where the herd is, because we're all dumb money. Like, I'm not right all the time. I'm right. I'm wrong all the time. But I'm able to, using good ethics, cut the losers, as they say, let the winners run. But, one kind of parlor game, if you will, is to find out where the dumbest of the dumb are. No one on this call, but, and you might have heard of this idea of the magazine cover as an indicator. They don't print magazines anymore. So in the book, I talk about actually The Simpsons as being a fantastic, at least historical indicator, oftentimes for major market moves. You all probably saw this morning that the Staples Center now, Staples, people don't even know what that is anymore. Is Staples even in business? Probably it's been merged into Sumitomo Corporation of South Korea. Staples Center will now be known as Crypto.com Arena in a huge $700 million deal. And price is always primary, but if you've kind of been around the block, as they say, you might remember this stadium indicator. Oftentimes the companies that, not always, but oftentimes, in fact, better than even odds of companies that enter in these major deals often end up not just underperforming, but literally going bankrupt, like going to zero. So here's my fearless prediction on Bitcoin. And I have to say, I have no interest long or short. I just, if you can ask me about my Bitcoin experience in the questions if you want, but I'm not kind of pumping or pooping, I guess. Look, all-time highs are bullish. When anything is hitting an all-time high, it's telling you something. It's telling you that the trend is up. And the biggest advantage you can have in the market is trading with the trend on your side. So new all-time highs are bullish. If I was looking to buy Bitcoin, I think the all-time high is probably 72. I mean, if it's at 60 now, I wouldn't want to buy it under 60. I want to buy it more like 65, 66, 69 for the move up to 100. I don't think you buy it on the way down. In fact, but here's my fearless prediction. Public adoption of Bitcoin, if you're kind of betting on more people getting involved or getting the word out or doing your little laser eyes thing to get, the more people adopt it, I think the more the price will go down. And I'm looking at a historical equivalent. Forgive the schmata there, but 20 years ago, it wasn't Bitcoin people were hyped about. This isn't a shitting at Bitcoin, but it was bandwidth. Anyone remember bandwidth? Well, bandwidth, that was going to be this is from, I believe, Bloomberg, the new currency in telecom, trading bandwidth and barons. Enron, of course, was going to be there, the big thing in buying and selling trading communications capacity. Because again, think back to 2000, it was like the internet was just starting. We're going to need a lot of bandwidth. And look, as I said, the internet did take off. I mean, internet users continues to go up, but bandwidth prices plummeted quickly, and trading evaporated. So that's my kind of fearless prediction for Bitcoin, is that the blockchain technology probably takes off. It's probably fantastic, just as the internet did. But the price of Bitcoin and all the associated currencies doesn't necessarily follow suit. So the moral of the story is, let price be your guide. Price is not just primary, it's everything. It's what we invest in, it's what we learn from, it's how we extrospect to the world, make sense of the world, make plans in the world. And it's not always perfect, but it puts the odds on our side. And so let price be your guide. And more than anything, this isn't a presentation about ethics, but don't double down. Remember, swingers, double down, don't double down. Doubling down is the worst possible thing you can do regardless. It's allocating more of your scarce resources to an objectively weak asset. You buy it at 50 and it's at 45. The market's telling you something's wrong. So it's okay to buy it at 50. It's okay to buy it at 52, 54, 55, 58. You bought it at, people are buying at 58 now. They'd love to have started at 50 where you are. But when it's moving against you, don't be that guy out in the Speedo in the rain. Be inside reading my book with a great cup of tea. Thank you to the Money Show for having me. Thank you for you all for checking out my book, Prices Primary, at Amazon.com. And I'd be happy to take any questions you have and invite you to always write me and contact me at capitalistpig.com.
Fantastic, Jonathan. We do still have a couple of minutes left if you want to answer some questions.
Sure, absolutely.
All right. So we have one from John that I'm curious about as well. He asked, what is the martingale strategy?
Oh, martingale. The martingale strategy. The martingale strategy is a betting strategy. And I don't like that. Basically, martingale strategy is doubling down. It's, I think it's the idea that, I don't gamble, but what's the one that goes around? Charlie, you know that. What's black.
Is that Russian roulette?
No, not Russian. It's roulette. It's roulette.
It is roulette. Okay.
You just say, I'm going to go black, and I got a 50-50 chance, and I'm going to just keep doubling. If it's red. So it's this idea that, you can just eventually it's going to come up your side. If you just keep doubling your size, you're going to eventually come out even. But what makes it so dangerous in the investment context is that at least when it's red or black, it's 50-50, right? But when you're talking about a market, a trend is the best indicator we have. So if you buy it at 50 and it's at 45, it's not a 50-50 whether it goes to 44. The market's already told us that it's breaking down to new lows, for example. So again, it's all about odds. People say, well, I followed your strategy and this time I lost. Well, it's not about always being right. It's about minimizing the losses, maximizing the gains. And when you focus on weak stocks, and when you use that martingale strategy, doubling down, it's so frightening how quickly you spend your very precious capital. And think about it, you're spending it on the worst possible odds. Not you, just whoever's asking this, but when we buy something that's going down, it's like we're allocating more and more money to something that it's not just our feelings that it's weak, the market's telling us. So love it at 50, Love it at 51, 55. But if you take that first price at 50 and it's at 44, I don't think you don't have to get out that moment, but you have to think of some place you have to pull the plug, because some things do go to zero and don't add on the way down. I mean, it's how you slit your throat. It's okay to be wrong. It's okay to be wrong. You're wrong all the time, but it's not okay to sacrifice yourself to be right. You're right. There's a lot of other, as they say, fish in the sea.
Oh, that's so scary. Yeah, definitely true. Let's see if we can end with one more question before we finish for today. Someone asked what prices are exciting to you right now.
Honestly, I'm looking at the price of first class tickets to Cozumel. If you know anything about Cozumel, my fiscal year is short-term rates certainly going up. I think if you've ever thought about, take the Fed out of it, I think if you've ever thought about a rising rate strategy, now is, I think, a good time to kind of look at it. I'm trying to think of I would look at it at a very minimum, the zero, what are they called? Zero rate bond ETFs. This is especially for fixed income investors. So basically the hedged bond ETFs, because that could be, people are waiting for a stock decline, and it could be really more of a bond decline. And I remember it wasn't too long ago that money market rates were 4 and 5%. So we could see it again in our lifetimes. That might be the next big major move. And no recommendations, but bonds could be a lot lower and yields could be a lot higher, and a lot of money could be made on the way down. Do your own due diligence and buy the book.
Yes, I am putting a link right now into the chat for you.
You're such fun, Charlie. Thank you so much. I hope that I see you again as well. And our audience.
I try. Well, that concludes our time for this session. I hope everyone had as much fun as I did. John, thank you so much for speaking with us today. It was truly a fantastic presentation. Check that out. Just fabulous. To our lovely viewers, please enjoy the remainder of this virtual expo. We do have a lot more in store for you today. I hope everyone has a wonderful day.